Did you know CPAs work around the clock on taxes, audits? Yes, it's quite a shock. But business owners, they've got a dream. More tax saving strategy, that's what they need. Welcome to Proactive Tax Strategies. And we're here to take away high tax fears. We got secrets, magic in our heads. Tune in as we travel.
Welcome to another episode of Proactive Tax Strategies. I'm Patrice Sikora. Our host, Ken New, brings more than 25 years of financial industry experience and expertise. Ken began his financial career at John Hancock, but today is the founder and owner of Pinnacle Financial Wealth Management, a private financial firm dedicated to providing holistic financial management and proactive tax strategies to high net worth individuals, CPAs, fellow advisors, and attorneys. As a team-based consultant, Ken collaborates with both local and national experts within an exclusive virtual family office model to provide the holistic approach to financial planning. Ken's dedication to full financial planning allows him to provide more value and increase client satisfaction. Ken is dedicated to discovering options for income and retirement planning with a definitive strategy to reduce taxes. Ken New is the host of the Proactive Tax Strategies podcast, where he showcases many unique tax mitigation strategies and retirement topics. Today, we have a special guest on the show with us, Roger Roundy. Now, Roger's story is one of entrepreneurial spirit and dedication to helping others navigate the complexities of risk and taxation. As the owner-CEO of Strategic Associates, LLC, Roger leads a team focused on educating clients about tax mitigation strategies and implementing solutions to protect their incomes from the erosive effects of risk and taxes. With years of experience, Roger has maximized his relationship capital to assist his expansive network of business owners and individuals with programs that offer tax mitigation solutions. Beyond his role at Strategic Associates, Roger is actively involved in other successful ventures, owning and serving on the boards of 3 insurance and consulting firms. Known as the visionary within those organizations, Roger brings his innovative mindset to drive growth and create value for clients and stakeholders alike. His mantra of work hard, play harder encapsulates his approach to both business and life, emphasizing the importance of enjoying success while creating opportunities for others to do the same. Roger loves the outdoors and activities like biking, skiing, snowmobiling, and hunting. And now, Ken, over to you.
Thank you, Patrice. Welcome, everyone. And thank you for being here with our broadcast today about proactive tax strategies. So I'm your host. And if you've been following Wes before, then you already know this. And some of you first timers, you're going to get to know the whole purpose of these podcasts is to expose you to powerful ways to, one, to optimize your financial future through tax strategies and finding money that's falling through the cracks. Many of these you've never heard before. So I've seen many high net worth people, particularly business owners, with 6-figure tax bills, substantial hard-earned money going to the government unnecessarily. Many CPAs, hardworking, dedicated CPAs, don't know or are not fully aware of these tax-saving opportunities. So today, we're going to dive into tax mitigation with a national expert, Roger Roundy. Roger, thanks for being here.
Pleasure. Excited to be here and talk about what we have to offer.
Roger, Patrice gave us some information about you in the beginning of the show. Could you start us off, tell us a little bit in your own words more about who you are, what you do, and what makes you passionate about what you do?
Thanks, Ken. Well, to kind of tell you a little bit about myself, my own words, I love our country. I think we live in the greatest place on earth. Even as screwed up as it is right now, I still think that we're blessed to live in the country that allows us to use capitalism to create wealth.
Mm-hmm. I hear you.
I do fly a flag out front of my house. I drive a Ford F-150, have a wife and 5 kids, 2 cats and a dog. I believe I'm about as American as it comes.
That is pretty
Other,
American.
other than I don't live in Texas, and then I'd be dialed in. Just kidding. Honestly. As Americans, I believe that all of us should pay as much in taxes as we're obligated to. I also believe that we should not pay a penny more. And so my career has been spent over the last 10, 12 years studying, analyzing, and introducing various tax mitigation solutions that I help my clients implement to utilize the benefits and incentives that are found in the tax code. Ultimately, the Fortune 500 guys, the Elon Musks and the Mitt Romneys and the Donald Trumps of the world, they don't pay a lot in taxes. And there's a reason for that. It's not because they're tax evaders. It's because they have teams of guys like me on their payroll. I consider myself more private practice, where I'll meet with the clients and help them learn and educate on the various incentives available and help them implement, because knowledge of these tax solutions is great, but application is power. So my firm, we vet out the various programs available. And once we're comfortable with a particular tax mitigation solution, whether we'll talk about the different types of tax mitigation solutions here in a bit, but regardless, once we're comfortable with a particular solution, that's when we'll add it to our repertoire of options. So that's me in a nutshell. I'm very passionate about what I do. I believe that if I can help the small to mid-sized taxpayer keep more of their hard-earned money, fairly confident, and we're not going to get political in this podcast, but I'm fairly confident that our clients are probably a little more fiscally responsible with their money than perhaps our government is. So if there's a legal, ethical, and moral way in which we can help them mitigate their tax liability using the incentives that Congress created, that's what drives me, is helping them find those solutions.
Love the idea. Make those dollars more efficient.
Absolutely.
Keep them in your own pocket. Don't unnecessarily send it over to Uncle Sam.
Correct.
Like it already. So there are many ways really to save taxes, and our CPAs, tax professionals, are there to help us with those. And the idea, I think, was germane to your comment. That is that only pay what you're obligated to pay. There's tons of 8,000 words or something like that in the tax code. I mean, pages of words and all those kinds of things. So this obligation to pay only what you're obligated to pay and not more is in understanding the tax code and being able to execute on that. And very often I hear someone come into my office, I advise on financial matters. And so a lot of times that advice is looking at taxes and mitigating taxes, and keeping it the lowest. And the CPA tells me I should contribute to an IRA. And I owe some taxes this year. And he says I could save $2,000 in taxes or things of that nature. And that's one of the ones that we hear a lot of. What's your take on that?
Well, very interestingly, it's important to understand the timing of tax planning. Typically, the CPA is saying that in February, March, or April, when they're preparing the tax return.
Yeah.
Well, in February, March, and April, you are down to just a few options to mitigate your prior year tax return. So contributing to an IRA does come with tax benefits. And understanding what the code says, which is, hey, we're incentivize you to save for retirement. So if you'll put money aside now, save it now, kick the can down the road for another, until you retire, age 59 and a half. That's a potential solution. It's not a horrible solution. It does mitigate your tax liability that year, but essentially the problem with an IRA is that you are kicking the can down the road to a time when potentially you have a higher tax liability, right? Because you're just taking money that was going to be taxed as ordinary income today, kicking the can down the road to when you're 59 and a half, or whenever you decide to pull the money out of your IRA or your 401k, it's still going to be taxed as ordinary income. So you are deferring the taxes, and that potential is that you can save money and put that money to work, and hopefully it grows and so forth. Is it the most efficient? Probably not. And we can talk more in depth about why I believe it's not quite the most efficient way to mitigate your tax liability. But the reason is that there wasn't proper tax planning in the tax planning season. So we'll talk a little bit more about timing, right? That's, to me, it's all about timing. When do you plan for your tax liability? Do you plan in February, March, April, or do you plan in October, November, December, when you still have time to implement more powerful, more beneficial strategies? And that's the key, I guess.
Yeah. Here's my perspective on that as well, is that, is that really a strategy? We have to take a step back from it. Are we really helping our client? We're masking a tax that's going to happen at some point in time in the future. We don't know what that's going to be. It might be good, might not be so good. But the proper use of that tax strategy is not being implemented. I have another one for you.
Okay.
I think that, happens very often. And that is that, well, like my farmer friends, I'm from Montana. The guys there, I got out of farming years and years ago, but it's always so nice to go back and listen to the stories. And I think, now we had a banner year this year. So I went to the tax guy and he says, well, let's go buy another tractor. Let's go buy another piece of equipment. And I step back from that for a moment and I think, okay, so now we're going to spend money to save money on taxes. What's your take on that?
We're getting closer, okay? Or at least we're spending the money in December when we find out what our tax liability. So I'm a little more happy, but my take, Ken, is this, and I say this all day, every day. Spending money to save in taxes is not tax planning. That's just silly, okay? If you need the equipment, okay, don't get me wrong. It's 162 is an excellent benefit, or 179, excellent benefit, right?
And those are tax code.
Those are the tax codes,
out.
right?
Yeah.
I apologize. Those are tax codes, right?
Yeah.
So if you need the new truck, or you need the new skid steer, you need the new farm equipment, by all means, go buy it. Yes, you get to accelerate the depreciation and get that deduction. Great. However, if you don't need it and you're just buying it, you're just spending money to save, spending $1 to save 60 cents. Is that really tax planning? Not necessarily, but it's one of the probably the most common deduction that every tax advisor suggests to their clients. Again, that's a spending money to save money in taxes.
Yeah.
We're getting closer because we're doing it at the right time. Again, back to the
Right.
timing issue, right? At least we're talking when we know there's a tax problem. That's my take.
And that's fantastic because of all the comments that I hear this time of year and, around tax season and so on. Those are the couple of ones that just bubble right up and everyone talks about that. And in some cases we're thinking, oh, geez, we did good. We're moving the needle here. And that's all fantastic. It really is. But let's dive into the meat of the conversation. I mean, taxes is really about tax mitigation. Is really about saving money on taxes, saving money, not spending money to try to save money. Because, isn't it true that if we spent money and we spent $100,000 and we got $40,000 tax, again, might be a good use of the money, but if the shiny object is to have the piece of equipment and we're spending 3 times as much money to get that kind of a tax savings, are we really saving taxes? That's not what we're all about here, is it?
Well, again, it's an option, but let's dive into what are the options? What are the things that I specialize in? Are we fair to go to that point of this,
No, absolutely. We want to get into ways to help taxpayers mitigate taxes, not mask what that problem might look like.
In our tax code, okay, there are incentives. That's all a tax code is. Congress sees a problem. They want to incentivize a fix. They want more housing, so they offer accelerated depreciation if you go build another apartment complex. Great. That's an incentive. We're utilizing the incentive. They want people to save for retirement, so they throw out 401k. 401k is a tax code. It just says save money for retirement. Understanding the intent behind the incentive, or what the code actually says, is super important because we're really trying to partner with the government. We're not trying to hide money from them. We're trying to utilize the incentives that they created. Okay, so that's me in a nutshell, right? I do love what I do, and I do create a lot of value, but I'm also conservative by nature, making sure that if we're going to implement any of these strategies, it's done within the intent and confines of the code, finding what the incentive really was for, and then implementing it for that particular purpose. Okay. My reputation as a tax mitigation specialist is super important to me, because if I'm throwing out fly-by-night tax strategies and something goes wrong, well, that's going to have a negative impact on my reputation, right? I'm not here just to save money in taxes. We're here to create value, put that value to work, and ultimately create legacies for the families that we're working with. So to kind of dive in just a little bit into what we're all talking about here, because now we've been in this conversation for 20 minutes, and let's talk about some meat. Okay.
Yeah.
In my career, what I've done is I've looked at the tax code, looked at the strategies, and I've broken the strategies into 3 categories. So anyone listening to this podcast could be making a categorical list here of the 3 categories of tax strategies. The first category is an area I call business deductions. The first 2 categories are going to be above the line deductions. Now, the line is your adjusted gross income. So you have above the line deductions and you have below the line deductions. Okay. The above the line deductions, one of those categories are business deductions. We've talked about that a little bit. Buy more equipment or create more expenses within your business. A key area that I focus in a lot on and have for 10 or 12 years is Section 831B, captive insurance and private reinsurance. It's an area that I'm an expert in. I have hundreds of clients that have had an 831B. And at this point, I'm going to pause just a little bit because I want to make sure everybody understands. Tax mitigation strategies can be used, they can be overused, and they can be flat out abused. Okay. Most of these strategies we're going to talk about have been abused. And for that purpose, the IRS is doing their job, which is scrutinizing the tax strategies available, right? So we live in a very capitalistic society, Ken, as you know, right? And sometimes we get a little carried away, especially the successful who are trying to figure out any possible way they can keep more money, right? Well, there's always a right way and a wrong way. The intent behind the
wrong kind of capitalism you're talking about. Yeah.
Yes, exactly. Right. We get a little aggressive, right? Well, understanding what the abuses are and understanding where the IRS takes issue with some of these things is very, very important. 831B is a prime example. It is heavily scrutinized. I welcome the scrutiny because I understand what the business owners are doing inappropriately. They're not following the intent of insurance, right? They're not following the rules of insurance. That's my job as an insurance manager, is to teach and educate business owners on the proper utilization of this program, right? We're not going to dive into the intricacies of this exact program today, but just know that's how I function. That's my life.
So I'm hearing you say that this is an ongoing process and strategy, not a one and done.
Not with 831B. Absolutely not. Right. It is a long-term risk and tax mitigation solution that can be very powerful, right? But I already said, I have a wife and 5 kids. I got to be able to sleep well at night knowing that the solutions that I'm introducing are appropriate and defendable, right? We're going to be doing things the appropriate way. So business deductions are one category, and 831B is one of those. The next category, I haven't given it a real good name yet, but I'm just going to say business ownership with tax benefits. Business owners have incentives. Congress tries to create incentives to encourage entrepreneurialism. So they want to encourage us to create. That's what stimulates the economy. So business ownership has tax benefits. There's lots of programs that we utilize within that category, right? Some that most people on this podcast have heard are things like buying real estate and using accelerated depreciation or a cost segregation study to accelerate the depreciation to take a bigger deduction in year one. It's a very common practice, right? There's other things like solar tax credits where you're buying solar and that has tax benefits, lots of different structures and programs. There's one in particular that's a business ownership program that allows us to accelerate expenses. Okay. I'm not going to dive into the intricacies of that program, but that's one that provides a very powerful deferral of tax liability. So business ownership with tax benefits is the next category. The next category is what I call leveraged charitable gifting. Ken, have you ever given away to charity?
I have, yes.
Okay. When you donate to charity, you typically get a 1-to-1 deduction. You give $10,000 to your church, you get to deduct $10,000. It's great.
Yeah.
However, what if you could increase the power or the leverage of your dollar? So that category is basically using the power of leverage to increase the purchasing power of your charitable donation, where a promoter of some sort has purchased some product, some service, whether it's real estate, mineral rights, medical supplies. The promoter is buying a whole bunch of something. And when you buy something, Ken, as you know, you go to Costco, you buy a box of candy bars, you get them for 50 cents a piece. But if you go to the convenience store, they're $2.50 a piece. Right? So the concept is using the purchasing power, volume discounting, to increase the leverage of your dollar. So they're buying $1 billion worth of product, but getting it for $200 million, you're getting the power of volume discounting. We buy in at the lower purchase amount, turn around and donate it at the higher street value. That power of leverage gives you a 1-to-5, a 1-to-6, a 1-to-10 offset against your leveraged charitable gift. So you're putting in $100,000, getting a $500,000 deduction. Understand how that works?
Absolutely.
Okay. So that's the category. And that is a personal deduction, a below the line deduction, right? So, and there's limits to how much we can gift each year, but those are the 3 categories that we specialize in. There's others, but if we were to break it down simply for this conversation, it's just understanding that there's options, and knowing what your options are is the first step. But the step before that is when. I'm not here to replace any CPA or tax attorney. I'm here to suggest that tax planning should happen all year long, but primarily in October, November, December, fourth quarter, when you know how much money you've made. That's when we plan for the tax liability. So the timing is as important as the strategy, because a lot of the strategies, 95% of them, have to be done in the year you want the tax planning. So we meet in the fall and fourth quarter, right? That's when you really should be working on your tax planning, not February, March, April, because then you're down to, hey, put money in your IRA. Okay, it works, but it's the best, right? That's the idea, is helping individuals really consider what their options are and know when to consider their options. That was a deep dive. So we're going to keep it fairly high level for this conversation.
Sure. And so when we think about this collaboration then with the CPAs, really your role then is to help CPAs and help tax professionals and help business owners and high net worth individuals, of course, to understand that these options exist, and then to go through a process then to determine how viable is it for their set of circumstances. Take the fact pattern, if you will, and look at that and start to help the CPA become more aware of how that applies to the taxpayer, whether it be the business entity, whether it be the high net worth individual, combination of both. And that's where the fun begins, because then you get to take those pieces of the puzzle and fit them together and then go through these processes of, and that's where I always say that's where the magic happens. That's where it becomes real for the taxpayer to be able to look at it and say, oh, well, my tax bill this year was $357,000. And now this thing is like not so much. And so we've moved the needle. And that's where the tax savings happen, is that going into this process, there's a certain amount of tax that would be owed. Coming out on the other end of this process, this is what we now can save. All right. Did I get that right?
You nailed it. So most of my time is spent educating. I have the team that vets the solutions out. They're the smart guys, the one who read the tax code and enjoy reading the tax code. I can read tax code. Do I enjoy it? Not necessarily. Okay. The guys who enjoy it and really understand what happens is all year long, right? Starting this time of year, we start being introduced to new programs. I turn those programs over to the smart team. They'll dissect it, look at the codes, make sure they're appropriate, make sure that the structure's sound, and make sure that we're willing and able to defend it. So we're creating this tool chest of options for our clients. For me, my ideal situation is come to me with your numbers. Let's figure out where your income's coming from, what type of income it is, whether it's business income or W-2 income, or is it a capital gain? Maybe you sold your business and you're staring down the barrel of a huge tax bill, right? That's when I come into play. We will look at the types of income, how much it's going to be. And then once we have a feel of the problem, then we're going to identify 1, 2, or 3 different solutions to help fix the problem or utilize the incentives in the code to benefit on the tax side. That education process happens. We make introductions all year long. We get to know people, try to make this relationship. And as you know, this day and age, it's all via Zoom. So I have clients in all 50 states about this point, right?
Yeah.
I haven't in North Dakota yet, but anyway, we're getting closer. So
I have one in North Dakota for you.
There you go. Perfect. But we really, it's an interesting proposition to via computer screen. I have to make a relationship with the client, help them understand who it is, what I represent, and what our objectives are. In the first 15 minutes of a conversation, make that relationship and then start educating on the solutions. And sometimes we only get 45 minutes to an hour to do that. Something we do all day, every day. But the idea is once you have a good feel of what your problem is going to be, type of income, how much it's going to be, then we'll sit down, take a look, and then I will identify. I consider my firm as a connector of people with problems to people with solutions. We help implement, we educate on the solutions and then help implement those solutions. So that's why we meet in the fall and determine what the problem is and then identify those solutions. So that's the process. And it can be very rewarding because I just got off the phone earlier today. Business owner making $6 million income a year. He pays $3 million in taxes. And once we got done, he's like, oh boy, where were you last year? Because that probably is the most common phrase I hear, Ken.
Yeah.
Where were you last year? Right. So we're not going to cry over spilt milk. We're going to clean it up, fix it for the future. There are a few things we can do to go back and get a little bit of past tax payments done. But really, we got to fix this year first. And then we talk about the future and then we talk about the past. And that's our process. Let's just meet with the client, figure out the problem, and identify the solutions.
Yeah, the key is the timing of it. And you mentioned that so many times. And the key thing is for a couple of reasons. One is that it is still in the tax year. So we're in the 2024 tax year. So coming up, and look, the year's half over almost. I mean, it's already there. And so now we're thinking about that comment that you made, meet in the fourth quarter, which is really now. I mean, it's this like get that relationship moving because now is the time that you can have the attention of the professionals that may want to be involved in this kind of decision making. The wrong time is to present this to a CPA on March 15th or heaven forbid later. And they're going bonkers with all this stuff that's going on and maybe a change in the tax law and maybe they're going to rekindle a tax law and you just don't know what's going on. So yeah, the idea to position yourself such that we're having meaningful conversations. I mean, that's a key to our practice is that we begin in June. And so we have a lot of conversation in June that we know is going to be somewhat watered down until we get into the fall. And then there's some giddy up then at that point in time and everybody gets a little bit motivated. And so one of the things, just as we start to kind of get a wrap up going here is that who is this for? I mean, these tax mitigation, what's the ideal client look like? I mean, you talked about that client obviously makes $6 million a year. Is this just for high net worth people making $6 million a year? What's a sweet spot? I mean, who's your ideal client?
For me and my firm personally, it's really hard to turn away someone who's making $300,000 a year and being taxed and losing a third of that to taxes. But ultimately, the solutions that we offer are really more beneficial for the higher incomes. The bigger the problem, the more efficacious.
Yeah, that makes sense. Sure.
Right. So there's ways to mitigate your tax liability if you're under $300,000 to $400,000, right? That's not our space. We're not going to help you do the Augusta rule or hire your kids or buy more equipment or have a home office. There's a lot of, I have a list of 12 of those types of solutions that I just
Those sound so cool. The Augusta rule. That's cool.
Right? So those types of solutions are more the smaller, right? Personally, that's not what I use, right? I like big deductions because I don't have to worry about how many miles I drove or if I use my credit card for personal business expenses. And, any business owners listening to this has heard this 100 times. Oh, just use your credit card and you don't know it's personal business. Hire your kids. That's not our world. Our space is really, we become beneficial if the taxable income is north of about $400,000 of ordinary income, or a capital gain of more than $500,000. If you kind of say, okay, how much income do I need to be making, or how much tax liability am I staring down the barrel of? It would be if you're paying more than about $100,000 a year in taxes, or projected to pay more than that, or if your income's more than $350,000 to $400,000. That's when we sit down, we take a look at what's going on, and then we start implementing or educating on the options available. But it's really, it is going to be more the higher incomes, because that's where the bigger problems are.
Yeah, the little solutions are for the lower amounts of income. However, tax strategies are universal. They work for lots of people.
Absolutely.
And that's where the magic's at. And the timing is all the key to it, is in the timing. And I love it. What a great way to really kind of wrap things up here. It's really been great listening to you talk about these strategies. Love to get deeper into it, but that's another conversation for us. But again, thank you so much. Great tax mitigation strategies. And I'm sure that our listeners are sitting back thinking, wow, I need to learn more about what I've just heard. With that, anything else that you'd like to mention at this point in time? Then we'll turn it over to Patrice to wrap it up.
Well, just in closing, Ken, here's my philosophy. The high net worth individuals, those who are making a lot of money and paying not a lot in taxes. The Fortune 500 guys is how I like to refer to them. Why should they have access to tax strategies that our clients, the small to mid-sized taxpayers, don't have? So my objective is to bring these bigger dollar deductions or solutions down to the small to mid-sized taxpayer, because I believe that demographic is grossly underserved, but is also the lifeblood of our economy. If I can help the small to mid-sized business owner mitigate their tax liability, they're going to put that money to work. They're going to hire more employees. They're going to grow their business. That's our passion, is helping that demographic. Because I don't really care, no offense meant, but I don't care if you save money in taxes. You already know how to do that, right? It's how do I help Mr. Grocery Store owner who's just working his butt off keep more of the money he's making, right? That's my objective. And the key of this whole conversation is a phrase I love to use. When you have an uncommon income, it deserves uncommon planning. That's our passion.
I love it. Yeah, terrific. Roger, thank you so much.
Thank you.
Great presentation.
Appreciate the time.
Ken, how can people reach you if they want to talk about this some more?
Well, by phone, of course. We still use phones, 321-454-3623, or go to our website at www.pinnaclefinancialwealthmgmt.com.
All right, and now you know how to reach Ken. So to know when a new episode of Proactive Tax Strategies is ready for you, all you have to do is follow this podcast. And of course, please share with others. Thanks for being with us.
Thank you for listening to the Proactive Tax Strategies podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.pinnaclefinancialwealthmanagement.com or give us a call at 321-454-3623. 3623. Securities offered through Arete Wealth Management, LLC, members FINRA and SIPC. Investment advisory services offered through Arete Wealth Advisors, LLC, an SEC registered investment advisory firm. Pinnacle Financial Wealth Management, Arete Wealth Advisors, and Arete Wealth Management are independent entities.